I'm James Sheehan, CEO and Managing Partner of Island Park Private Wealth. And here's what you need to know about the markets this week. Stocks traded lower as interest rates continued to climb. The S&P 500 fell about 2%, the Nasdaq dropped just over 3%, and small caps in the Russell 2000 were down 2% as well. Value stocks held up much better than growth this week, as the high valuation technology names sold off the hardest. On the sector side, energy was the standout, gaining nearly 5%, with healthcare not far behind at 3%, while technology and industrials lagged. Bonds moved lower too as yields rose, the dollar weakened, and Bitcoin was a bright spot, gaining more than 14%. So what's driving all this? A few things stood out to me this week. First, the consumer is still spending, but at a more moderate pace. Retail and food service sales fell 0.6% in July, after only a modest gain in June. Some of that softness was likely timing related, tied to Amazon's Prime Day pulling sales forward into late June. But even stripping that out, spending outside of autos and gasoline was still down slightly. The bigger picture is that total retail sales remain 5% above where they were a year ago. Second, consumer confidence weakened again in early August. The University of Michigan Sentiment Index dropped to 51 from 55 in July, giving back the improvement we'd seen over the prior 2 months. What really stands out to me is that only 8% of consumers now expect their income to outpace inflation over the next year. Higher prices, especially energy costs, are clearly weighing on how people feel about their purchasing power. Third, rising oil prices and a cautious Federal Reserve are complicating the interest rate picture. Oil moved higher again this week on renewed concerns around the Strait of Hormuz, and higher energy costs put pressure on both consumers and inflation at the same time. Minutes from the Fed's July meeting showed policymakers are still worried about inflation. Normally, softer consumer data would build the case for lower rates, but higher energy prices are limiting how quickly the Fed can respond. Fourth, and this is the one I'm watching most closely, long-term Treasury yields aren't behaving the way you'd expect. The 30-year Treasury yield climbed above 5.3% this week, its highest level since 2007. Normally, softer growth pushes investors toward the safety of Treasuries, and yields fall. Instead, inflation concerns and heavy government borrowing are keeping long-term rates elevated. Finally, stocks are simply working through the impact of these higher rates. The market has been fairly resilient overall, but this rate move has clearly added to volatility, and technology was the sector that felt it the most this week. Looking ahead, we've got a busy week of data on deck, including the Consumer Confidence Index, new home sales, and the PCE inflation report, all of which will clarify the trend. As always, if you have questions about how any of this affects your portfolio or your plan, please don't hesitate to reach out. Have a great week.